My name is Asta Seni, and today I'm presenting a comprehensive financial analysis of Emaar Properties' 5 green initiatives. This analysis examines how sustainability investments can generate exceptional financial returns while supporting the UAE Net Zero 2050 commitment. Let's begin. Here's the bottom line. I've analyzed 5 sustainability initiatives across Emaar's portfolios, including solar energy, water recycling, waste management, construction waste recycling, and EV charging infrastructure. The total required investment is 365 million AED. Over 30 years, these initiatives will generate a net present value of 1.31 billion AED. That's a 268% return on investment. But this isn't just about profits. These 5 initiatives will eliminate 4.13 million tons of carbon dioxide emissions over 3 decades, directly supporting UAE's national climate goals. The average payback period across the portfolio is just 2.8 years, meaning Emaar recovers its investment quickly while creating long-term value. So why Emaar? First, scalability. Emaar is the UAE's largest property developer, managing 47 square kilometers of built environment. This massive footprint creates extraordinary opportunities for sustainability initiatives that smaller developers simply cannot achieve. Second, regulatory alignment. The UAE government has committed to achieving net zero emissions by 2050. Companies like Emaar that invest in green infrastructure today will benefit from future carbon pricing mechanisms and regulatory incentives. Third, market demand. Today's tenants and property buyers actively seek sustainable buildings. Green certifications command premium rents and higher property values. This isn't theoretical, it's current market reality. My analysis uses a 30-year time horizon as recommended for infrastructure projects with a 12% discount rate reflecting industry standards for UAE real estate investments. Let's examine our first initiative, solar energy integration. Emaar's properties have vast rooftop space currently generating zero value. By installing solar photovoltaic panels across the portfolio, we transform these roofs into power generating assets. The key actions include installing 200 megawatts of solar capacity, integrating with existing electric infrastructure, implementing smart energy management systems, and connecting to DEWA's grid through net metering arrangements. The environmental impact is sustainable, reducing 2.8 million tons of carbon emissions over 30 years. That represents 68% of total portfolio's emissions reduction potential. Now, let's look at the financial performance of solar energy. The capex breakdown shows we need 73 million AED total investment. This breaks down as 30 million for solar panels, 15 million for inverters, 12 million for mounting systems, 10 million for electrical infrastructure, and 6 million for installation and labor. The net present value is 571 million AED. The emissions abatement is 2.8 million tons of CO2. And here's the critical number. The marginal abatement cost is just 26 AED per ton. To put this in perspective, the industry average is over 200 AED per ton. This is exceptionally cost effective. The emissions reduction chart shows gradual ramp up. We start at 80% efficiency in years 1 and 2 as systems are commissioned and optimized. By year 3, we reach 100% efficiency, and emission saving accumulate steadily over the 30-year horizon. The NPV buildup and payback analysis reveals something remarkable. This initiative pays back in under 1 year. The red dashed line shows we recover our 73 million investment in approximately 11 months through electricity cost savings. After that, every year we generate pure profits. Annual operational savings total 80 million AED per year from eliminated electricity purchases from DEWA. Solar energy is a star performer, the clear priority for immediate deployment. Now, moving on to Initiative 2, that is water recycling and smart irrigation using treated sewage effluent or TSE systems. Currently, Emaar uses expensive desalinated drinking water for landscaping and cooling towers. That's like watering your garden with bottled water, economically inefficient and environmentally wasteful. We install TSE treatment plants that recycle wastewater for non potable uses. Key actions include implementing treatment facilities across properties, installing smart irrigation controllers, and creating dual piping system to separate potable and recycled water. The impact: reducing 420,000 tons of carbon emissions by avoiding the energy incentive desalination process. Water recycling requires a large upfront investment but delivers strong strategic value. The total capex is 111 million AED. The largest component is the TSE treatment plant at 45 million, followed by piping and distribution at 25 million, pumping stations at 20 million, storage tanks at 12 million, and control systems at 9 million. Net present value is 66 million AED. Emissions abatement is 420,000 tons. The marginal abatement cost is 264 AED per ton, higher than solar but still economically valuable. The ramp up schedule is more conservative here. We start at 40% efficiency in years 1 and 2, increase to 60% in years 3 and 4, and reach full capacity at 100% by year 5. This reflects the complexity of installing dual piping infrastructure across existing buildings. Payback occurs in approximately 5 years. Annual savings of 22 million AED come from reduced water purchases and lower energy costs. The strategic value extends beyond pure financial returns. Water security is a national priority in the UAE. This initiative positions Emaar as a leader in resource conservative while reducing dependence on energy incentive desalination. The third initiative is plastic and paper waste management. Currently, Emaar sends 65% of operational waste to landfills, thus literally throwing away money while harming the environment. We implement comprehensive recycling programs across all properties. Key actions include installing segregation systems at source, training staff and residents, partnering with local recycling facilities, and creating revenue streams from recovered materials. The result: diverting 510,000 tons of carbon emissions from landfills while recovering valuable recycled materials. Waste management is our second best financial performer. Total investment is 60 million AED, allocated across segregation bins and systems at 20 million, compactors and balers at 15 million, collection vehicles at 12 million, recycling facilities at 8 million, and training and software at 5 million. Net present value is 464 million AED. Outstanding returns indeed. Emissions abated totals 510,000 tons. Marginal abatement cost is 118 AED per ton, which makes this highly cost effective. Now, the ramp up follows a similar pattern to water. We start at 50% efficiency in years 1 and 2 as residents adapt to new segregation requirements. We increase to 75% in years 3 and 4, reaching full 100% diversion rates by year 5. Now, here's the impressive part. Payback occurs in under 1 year. Annual savings of 65 million AED come from two sources: avoided landfill disposal fees of approximately 25 million per year and revenue from selling recovered materials at 40 million per year. This initiative transforms a cost center into a profit center while dramatically reducing environmental impact. It's a clear priority for early deployment alongside solar energy. Moving on to the fourth initiative, construction and demolition waste recycling. Emaar constantly has multiple construction projects running simultaneously. Currently, construction waste goes to dumps requiring expensive transportation and disposal. We install on site recycling equipment that processes concrete, steel, and aggregates for reuse. Key actions include crushing and screening equipment at construction sites, quality control for recycled materials, and integration into new building specifications. This circular economy approach reduces 250,000 tons of carbon emissions while cutting both disposal costs and virgin material purchases. Construction waste recycling requires patience but delivers strategic benefits. Total capex is 70 million AED. This includes crushing equipment at 20 million, screening machines at 15 million, sorting systems at 12, on site processing facilities at 15 million, and transportation fleet at 8 million. Net present value is 156 AED. Emissions abatement is 250,000 tons. Marginal abatement cost is 280 AED per ton, our highest MAC but still economically justified. The ramp up mirrors the waste management schedule: 50% efficiency in years 1 and 2, 75% in years 3 and 4, and 100% by year 5. This reflects the time needed to train construction teams and validate recycled material quality. Payback occurs in approximately 2.5 years. Annual savings of 28 million AED come from avoided dump fees and reduced purchases of virgin construction materials. Beyond the numbers, this initiative positions Emaar as a sustainability leader in the construction industry. As green building certifications requirements tighten, having established C&D recycling capabilities creates competitive advantage for winning new development projects. Moving on to the fifth and the last initiative, that is EV charging infrastructure. The question isn't whether electric vehicles will dominate the market, it's when. Emaar properties must be ready for this transition or risk losing competitive position. We install over 2,000 charging points across the portfolio. Key actions include level 2 and DC fast chargers at strategic locations, integration with property management systems, payment and reservation software, and partnerships with DEVA for grid capacity. The environmental impact is 150,000 tons of emissions reduction as residents and visitors shift from gasoline vehicles to electric vehicles. EV charging infrastructure is about future proofing Emaar's properties. Total investment is 42 million AED. That is the smallest from all of our initiatives. The breakdown is charging station hardware at 18 million, grid connections and transformers at 10 million, software and payment systems at 6 million, civil works and installation at 5 million, and signage and amenities at 3 million. Net present value is 55 million AED. Emission abatement totals 150,000 tons, and the marginal abatement cost is 280 AED per ton, matching C&D waste recycling. The ramp up here is the slowest, reflecting market adoption rate. We project 30% efficiency in year 1 and 2 as early adopters use the infrastructure. This increases to 60% in years 3 through 5 as EV prices decline and availability improves. We reach 90% efficiency by year 6 and beyond as EV becomes mainstream. Payback occurs in 3.5 years. Annual revenue of 12 million AED comes from charging fees paid by users. The strategic value exceeds the pure financial returns. Properties without EV charging will lose tenant appeal as the markets shift. This initiative ensures Emaar stays ahead of the curve rather than playing catch up in 5 years when charging becomes mandatory for premium properties. Now let's take a step back and look at the entire portfolio. The NPV comparison shows clear prioritizations. Solar energy dominates with 571 million AED, representing 44% of total profit value. Waste management contributes 644 million together. Together, these two initiatives account for almost 1 billion or 75% of total NPV. Waste recycling adds 66 million, C&D waste contributes 156 million, and EV charging provides 55 million. Notice that every single initiative shows positive NPV. There are no losers here, just different magnitudes of winners. Now, if you look at the emission distribution chart and you look at the donut, it tells a similar story. Solar delivers 68% of total emissions reduction. The other four initiatives combine for 32%. This concentration makes strategic sense. We should deploy solar aggressively while phasing in the complementary initiatives. The cost effectiveness analysis examines marginal abatement cost versus emissions impact. This helps us understand not just total value but efficiency. How many AED we spend per ton of CO2 reduction. Solar achieves the lowest MAC at 26 AED per ton. Waste management is second at 118. Water, C&D, and EV cluster at the higher end between 264 and 280 AED per ton. Let's look at this more closely on the next slide with our quadrant analysis. Now this bar chart visualizes the NPV hierarchy clearly. Solar's 571 million NPV bar extends furthest. Waste management at 464 million is second. Then we see a significant drop to C&D at 156 million, followed by water at 66 million and EV at 55 million. The key insight cards at the bottom summarize our strategic approach. Deploy solar and waste immediately in years 1 and 2 to capture 79% of portfolio value with less than 1 year payback. Use the cash flow generated to fund the remaining 3 initiatives in years 3 through 5. This scatter plot is a strategic decision framework. It maps each initiative on 2 dimensions. The horizontal axis shows emissions abated, that's environmental impact. The vertical axis shows marginal abatement cost, that's financial efficiency. We've divided this into 4 quadrants using median values as thresholds. The bottom right quadrant is labeled optimal, low cost per ton, high emissions. Solar energy sits here, marked with S. This is the absolute best combination. Maximum environmental impact at minimum cost. Solar is our top priority for immediate aggressive deployment. If you look at the bottom left, it's consider. Low cost but smaller emissions. Waste management marked W sits here. It's financially attractive even though total emissions are lower compared to solar. This makes it our second priority. The upper right would be caution. High cost but high emissions. We don't have initiatives here, which is positive. The upper area shows water recycling marked WR, C&D marked C, and EV marked as E. These have higher costs per ton of 264 to 280 AED as it was showed earlier. They are economically viable but require more careful phasing to manage cash flow. The takeaway: this quadrant analysis validates our recommendation to prioritize solar and waste in the short term, then phase in water, C&D, and EV over medium term as early cash accumulates. Now in this chart, the emissions distribution donut chart shows solar energy's dominance visually. The large green segment represents 68% of total emissions abatement. That's 2.8 million tons. Waste management contributes 12%, shown in orange at 5, um, 510,000 tons. Water recycling adds 10% in purple at 420,000 tons. C&D provides 6% in blue at 250 tons, and EV charging contributes 4% in yellow at 150,000 tons. Total portfolio emission reduction is 4.13 million tons of CO2 over 30 years. To put this in context, that's equivalent to taking approximately 900,000 cars off the road for 1 year. Now, this comprehensive table summarizes all key financial metrics for each initiative. Total capital expenditure across the portfolio is 356 million AED. Solar requires 73 million, water 111 million, waste 60 million, C&D 70 million, and EV at 42 million. Annual operational savings total 207 million AED when all initiatives reach full efficiency. Solar generates 80 million per year. Waste generates 65 million, water saves 22 million, C&D saves 28 million, and EV generates 12 million in charging revenue. The payback column shows the recovery timeline. Solar and waste both achieve payback in under 1 year. C&D takes 2 to 3 years, EV requires 3 to 4 years, and water takes 4 to 6 years. The total portfolio achieves 1.31 billion AED net present value with an average payback of 2.8 years. This represents a total of 268% return on our investment over 30 years. Now moving on to the next slide, we have UN SDG mapping. All these initiatives align with 6 UN Sustainable Development Goals. Solar energy supports SDG 7, affordable and clean energy, and SDG 13, climate action. We are directly contributing to clean energy transition and climate mitigation. Water recycling addresses CDG 6, clean water and sanitation, and CDG 12, responsible consumption. We are conserving precious water resources and reducing wasteful practices. Waste management and C&D recycling both target CDG 12, responsible consumption, and CDG 11, sustainable cities. We are promoting circular economy principles and reducing pollution. EV charging infrastructure supports CDG 11, sustainable cities, and CDG 13, climate action through clean transportation. This alignment with global sustainability frameworks opens doors to green financing, ESG investor interest, and international recognition. Companies with strong SDG performance trade at premium valuations. Now, here are some recommendations for years 1 and 2, that is, your short term recommendations. Priority 1, deploy solar energy aggressively. Target 80% coverage by year 2, with 73 million capex generating 571 million NPV and payback under 1 year. This is the obvious starting point. Priority 2, roll out waste management systems simultaneously. That 60 million investment delivers 464 million NPV, also with sub 1 year payback. Together, solar and waste require just 133 million capital but generate 1.04 billion in value. That's 79% of portfolio NPV from 37% of capital. Supporting actions. Start pilot programs for water recycling at select properties to prove the concept. Begin EV charging installation in flagship to uh, in flagship developments for visibility. Establish C&D waste segregation protocols at active construction sites. The strategy is deliberate. Quick wins first, prove the concept, build momentum, generate positive cash flow that funds the next phase. And now, here are some um, medium term recommendations for years 3 through 5. We scale and we expand. Continue solar deployment at 100% coverage across the entire portfolio. This maximizes the 571 billion NPV opportunity. Expand water recycling to all water intensive projects. The 111 million investment delivers 66 million NPV while addressing water security, a strategic national priority. Scale waste management to achieve 75 to 100% diversion rates. This captures the full 464 million NPV while establishing Emaar as a circular economy leader. Implement the full C&D waste recycling program across all construction projects. The 70 million investment generates 156 million NPV while creating competitive advantage for future green building certifications. Complete EV charging rollout to 90 to 100%. The 42 million investment yields 55 million NPV while future proofing properties for the inevitable EV transition. Establish comprehensive monitoring systems with real time dashboards for continuous optimization and performance tracking. Moving on to the appendix part that provides detailed financial breakdown of the first four initiatives. Part 1 covers solar energy and waste management, our two priority initiatives. For solar, you can see the complete capex allocation across solar panels, inverters, mounting system, and installations. Annual OPEX savings of 80 million, NPV of 571 million, emissions of 2.8 million tons, MAC of 26 per ton, and payback under 1 year. For waste management, the detailed breakdown shows segregation systems, compactors, collection vehicles, recycling facilities, and training. Annual savings of 65 million, NPV of 464 million, emissions of 510,000 tons, MAC of 118 AED per ton, and payback under 1 year. All the calculations use a 30-year horizon with 12% discount rate as recommended for infrastructure investments. Here's the second part of the appendix. It covers C&D waste recycling, EV charging infrastructure, and the complete portfolio summary. C&D waste details show crushing equipment, screening, on-site facilities, transportation, and sorting systems. Annual savings of 28 million, NPV of 156 million, emissions of 250,000 tons, MAC of 280 AED per ton, and payback of 2 to 3 years. And the EV charging breakdown includes charging station hardware, grid connections, software systems, civil works, and signage. Annual revenue of 12 million, NPV of 55 million, emissions of 150 tons, MAC of 280 per ton, and the payback coming to 3 to 4 years. The portfolio summary table shows all 5 initiatives side by side. You can verify each number: total capex of 356 million, total NPV of 1.31 billion, total emissions of 4.13 millions abated, average payback of 2.8 years, and portfolio revenue of 268%. Let me conclude the presentation by bringing this entire analysis together. Since our focus is on sustainable finance, the environmental impact is substantial. 4.13 million tons of CO2 emissions eliminated over 3 decades. This represents approximately half a percent of UAE's total annual emissions, a meaningful contribution from a single private company. The strategic value is also clear. Early movers in sustainable real estate are capturing premium pricing and tenant loyalty. Emaar can lead this transformation rather than follow its competitors. The implementation approach is pragmatic. Deploy solar and waste management immediately in years 1 and 2. These quick wins deliver 1.04 billion NPV with sub 1 year payback, which is, in my opinion, immaculate. Generating cash flow that funds water recycling, CND waste, and EV charging in years 3 to 5, this is self financing growth. My recommendations as a consultant would be approve this portfolio immediately, being solar and waste deployment within 6 months, monitor performances quarterly, scale proven initiatives aggressively. This is how Emaar becomes both the most profitable and the most sustainable developer in the Middle East. The financial returns justify the investment on pure business grounds. The environmental impact positions Emaar for the carbon constrained future that's coming whether we like it or not. Sustainability and profitability are not trade offs, they are complementary strategies for long term value creation. Thank you so much.